Welcome to The Explainer. Today, we're cracking open the latest financial report from one of the world's top luxury watch retailers, the Hourglass. We're going to see what the story is behind their latest numbers. And wow, the headline number is a real showstopper. For the 6 months ending in September 2025, their profit didn't just inch up, it absolutely surged by 23% compared to last year. In today's economy, a lot of companies are just hoping for single-digit growth. So a number like this, it's not just good, it is exceptional. So you see a number like that, and you've got to ask, with all this chatter about a tough economy and people being careful with their money, how on earth does a luxury retailer pull off such a massive win? All right, let's dive in and really unpack the story behind these numbers. So to really get it, here's how we're going to break it all down. First, we'll look at the big picture. Then we'll get into the nitty-gritty of the numbers themselves. After that, we're going to explore what's actually driving this incredible growth. We'll also do a quick financial health check on the company. And finally, we'll take a peek into what they're seeing up ahead. Okay, let's start with a 30,000-foot view of the first half of their 2026 fiscal year. If there's one key takeaway here, it's got to be resilience. I mean, think about it. While so many businesses are playing defense, the Hourglass is showing that the appetite for high-end watches isn't just surviving, it's actually thriving. That tells you something really powerful about their clientele and the iconic brands they represent. But how did they actually get to that 23% profit jump? What's the journey from a sale to the final profit look like? Let's peel back the layers on their income statement and see how they built this. So it all starts at the top line with sales. Their revenue shot up by a very solid 14%, hitting over 615 million Singapore dollars. That just means more customers were coming in and, more importantly, they were buying. This is the fuel for everything else we're about to talk about. And here's the best part. That extra revenue wasn't just eaten up by costs. No, it flowed right down to the bottom line. After all the bills and taxes were paid, their profit rocketed up by that impressive 23%. This tells us they aren't just selling more, they're selling more smartly. So, what does this actually mean for someone who owns stock in the company? Well, that's where earnings per share, or EPS, comes into play. It grew by an even faster 24%. You can think of it as each individual share of the company becoming more profitable. It's a really direct measure of the value they're creating for investors. And this table right here, this lays it all out beautifully. Just look at the consistency. Revenue's up 14%. Okay, now look at gross profit. That's basically what they make on the watches themselves. Before other expenses, it's also up 14%. Now this is so important. It means they aren't slashing prices to get sales. Their margins are holding strong. And because those margins are stable, that growth at the top supercharges the profit numbers all the way down. It's a thing of beauty in a financial statement, really. Okay, so we know the what. Fantastic growth pretty much everywhere. But now we've got to understand the why. What were the tailwinds pushing them forward, and what were the headwinds they had to navigate to get these results? Now this is where we see the real chess match. On one hand, they have incredible pricing power. That stable gross margin of nearly 31% tells you they're selling these highly sought-after watches at full freight. But on the other hand, the cost of doing business is going up. A 90% jump in rental expenses. That is huge. That doesn't just happen by accident. It strongly suggests they're making big strategic investments, like opening new, bigger flagship boutiques in prime locations. So the real victory here is that their sales growth was powerful enough to absorb all these rising costs and still deliver that amazing profit growth. A big profit number is great, but to get the whole story, you gotta look deeper. A truly healthy company needs a rock-solid financial foundation. So let's give the company a quick checkup by looking at its balance sheet and cash flow. So when you're a profitable company, you have options. You can sit on your cash, or you can put that money to work. And the Hourglass? They chose to put it to work in a very big way. So what did they do? They spent over 75 million Singapore dollars to buy a new business in Australia. This was a major strategic play to grow their presence there. And what's really fascinating is that a huge chunk of that price, almost $69 million, was recorded as an intangible asset called goodwill. So what in the world is goodwill? Well, in the simplest terms, it's the premium you pay for a company above and beyond the value of its physical stuff, its stores, its inventory. It represents the value of things you can't touch, like the company's brand reputation, its loyal customer base, its great relationships. It's basically a bet on the future earning power of that business you just bought. So while they're making this massive move down in Australia, they're also juggling the day-to-day. They're stocking up on inventory, up to almost $350 million worth of watches, because, hey, you can't sell from an empty cart. They're borrowing a bit more to help fuel all this expansion, but here's the really impressive part. Even with all of that going on, they are still returning cash to shareholders through dividends and buying back stock. It's like they're playing offense and defense at the very same time. And this cash flow chart, it paints the perfect picture of what I'm talking about. See that big blue bar on the left? That's the cash machine. That's their core business of selling watches, just churning out almost $106 million in cash. And the other two bars, that's where the cash went. A huge chunk went into investing and growing the business with that Australian acquisition, and another piece went to rewarding their investors. This is exactly the kind of healthy cash flow story you want to see. So after an incredible first half filled with growth and big strategic moves, what did the future hold? Let's take a look at what the company itself had to say in their report. The company is being really straight here. They're acknowledging the challenges out there, trade tensions, economic worries, all the stuff we're hearing about on the news every day. They're not putting their head in the sand. But then they immediately pivot to their core strength, their amazing relationships with the absolute best watch brands in the world. They believe this foundation is their shield, making them tough enough to keep performing well, even if things get a little choppy. So what's the bottom line here? Well, this report shows us a company that's really firing on all cylinders, growing sales, making smart investments, and managing its finances well. But the big question hangs in the air. Can the timeless allure of a luxury watch keep defying the ups and downs of the wider economy? It's a fascinating question, and one we'll definitely be watching. Thanks for joining me on The Explainer.